Today we're going to explain moral hazard. It is a form of asymmetric information. Moral hazard occurs when one party takes more risks after a transaction or after an agreement because they are now protected from some of the consequences of their actions, while the other party cannot fully observe or control that behavior. So, moral hazard happens when protection changes behavior. If someone does not bear the full cost or the full consequence of risk taking, they may take more risks than before. This is why moral hazard is often an after transaction problem. The agreement has already happened, the insurance has already been bought, the guarantee has already been given. Or in the case of banks, the expectation of government support already exists. The information problem is about hidden actions. One party knows how much risk they are taking. The other party cannot fully observe or control that risk taking. Now, let's apply this to two examples, the car insurance and banks and bailouts. So let's start with the car insurance example for illustrating moral hazard. Before buying car insurance, a driver may know that if they damage the car, they will have to pay the costs, the full costs themselves. Because of this, the driver has a strong incentive to be careful. They may drive more slowly, they may avoid risk overtaking, and they might park more carefully. They may pay close attention to road conditions. The reason is simple. If something goes wrong, the driver personally bears the financial cost, the full costs. Now suppose that the driver buys comprehensive car insurance. If the car is damaged, the insurance company covers most of the costs. The driver no longer faces the full financial consequence of an incident, of an accident. This changes the driver's incentives. The driver may still want to avoid an accident, but the private cost of risky behavior is now lower than before. So consequently, the driver may become less careful. They may drive faster, park less carefully, and they may take more risks on the roads. This is moral hazard. The key point is not simply that the driver has insurance. The key point is that the insurance may change the driver's behavior after the insurance contract has been signed, has been agreed. The insurance company cannot sit beside the driver to monitor his or her every decision. The driver knows how carefully they are driving, but the insurer does not. This creates asymmetric information after the transaction. And the hidden action is the driver's behavior. The insurer cannot fully observe whether the driver is being careful or very reckless. So this can eventually lead to market failure because the person making the risky decision does not now bear the full cost of that decision. The driver may receive the private benefit of taking more risks, such as saving time by driving faster or making less effort to avoid damage. But some of that cost is now passed on to the insurer. Eventually, the cost may be passed on to other customers through higher insurance premium. So moral hazard can create an inefficient outcome, a market failure in the insurance market. Risk-taking becomes higher than it would be if the driver had to bear the full cost, the full consequence of their actions. A moral hazard also happens in the financial market. Well, imagine a large bank believes that it is too big to fail. This means that the bank believes that if it gets into serious financial trouble, the government or the central bank may rescue it to protect the wider economy. This expectation changes banks' incentives. If the bank takes risky decisions and those decisions succeed, the bank may earn higher private benefit, higher private profit. For example, it may earn large returns from risky lending, very risky investment, or complex financial products. But if those risky decisions fail, the bank may not bear the full cost. Some of the cost may fall on taxpayers, the government, or the wider financial system. This is moral hazard. The bank is insulated, is protected, or believes that it is protected from the full consequence of failure. So it may take more risks than it otherwise would. But the key problem is that the bank's private incentives may not match the interests of society. And from the bank's point of view, risk taking may be profitable, it may be attractive. Right. But from the society's point of view, excessive risk taking can be dangerous and costly. If a major bank fails, confidence in the banking system may fall. Other banks may become less willing to lend, and credit may become harder to access. Businesses may struggle to borrow for investment, and consumers may reduce spending, and the wider economy may suffer. Right. So it can affect not just one firm, one bank, but also the stability of the whole financial system. Right. Now we need to be very careful not to confuse moral hazard with adverse selection. Both moral hazard and adverse selection are examples of asymmetric information, but they happen at different point of time. Adverse selection happens before the transaction, but moral hazard happens after the transaction. And adverse selection is about hidden characteristics, but moral hazard is about hidden actions.